5 signs you're getting a good mortgage deal. Are you securing a mortgage that sets you up for homeownership success, or are you at risk of terms that could strain your finances? In the world of real estate and housing, a good mortgage deal is like a sturdy bridge. It carries you to your dream home with affordable payments, fair costs, and peace of mind. A well-chosen mortgage aligns with your budget, supports your long-term goals, and avoids hidden pitfalls. Some buyers rush into loans with high rates or risky terms, facing stress and financial hurdles, while others spot the signs of a great deal, locking in terms that pave the way for stability. The difference often lies in 5 key signs, clear indicators that you're getting a good mortgage deal. In this article, we're diving into these 5 signs, grounded in real estate and financial research, to help you evaluate your mortgage and proceed with confidence. By the end, you'll know exactly what to look for, what these signs mean, and, most importantly, how to ensure your mortgage is a win for your homeownership journey. Stay with us until the end, because a good mortgage deal isn't just about buying a home, it's about building a future of financial security and pride. Let's get started. Sign 1. The interest rate is competitive with current market rates. One of the most critical signs you're getting a good mortgage deal is that the interest rate is competitive with current market averages for your loan type and credit profile. A 2025 report by Freddie Mac indicates that 30-year fixed mortgage rates averaged 6.5% for borrowers with good credit, 720+ score, while 15-year loans averaged 5.8%. For a $300,000 loan, a 6.5% rate means $1,896 monthly payments and $382,560 total interest over 30 years. But a 7.5% rate increases payments to $2,097 and interest to $454,920, a $72,360 difference. A rate at or below market averages saves you thousands and signals a fair deal. Picture Sarah and Tom, both 35, applying for $350,000 mortgages. Sarah, with a 740 credit score, secures a 6.3% rate, slightly below the 6.5% market average, saving $7,920 over 30 years compared to 6.5%. Tom, with a 700 score, accepts a 7.8% rate without shopping around, costing $57,960 more than Sarah. Sarah's competitive rate signals a great deal, while Tom's high rate kindles financial strain. A competitive rate doesn't just lower payments, it reduces total loan costs, frees up cash for other goals, and reflects lender fairness. The good news? You can ensure a good rate. Check current rates on Bankrate or NerdWallet, filtering by your credit score and loan type, fixed, adjustable, FHA. Get quotes from at least 3 lenders, banks, credit unions, or online platforms like Rocket Mortgage, to compare APRs, rate plus fees. Ask yourself, is your rate at or below market averages, or higher? A competitive rate isn't just savings, it's the foundation of a mortgage deal that works for you. Sign 2. Closing costs are reasonable and transparent. If your mortgage closing costs are reasonable, typically 2 to 5% of the loan amount, and fully transparent, with no hidden fees, it's a strong sign you're getting a good deal. A 2023 study by the Consumer Financial Protection Bureau, CFPB, found that average closing costs for a $300,000 loan range from $6,000 to $15,000, covering fees like appraisal, $500 to $1,000, title insurance, $1,000 to $2,500, and lender origination, $1,000 to $3,000. Transparent lenders provide a loan estimate within 3 days, detailing all costs, ensuring no surprises at closing. Imagine Mia and Liam, both 40, securing $400,000 mortgages. Mia's lender charges $10,000, 2.5%, in clear, itemized fees, explained upfront, fitting industry norms. Liam's lender quotes $18,000, 4.5%, with vague processing fees, revealed late, straining his budget. Mia's reasonable, transparent costs signal a solid deal, while Liam's high, murky fees kindle distrust and risk. Reasonable, transparent closing costs don't just save money, they build trust, simplify budgeting, and protect against predatory lending. The good news? You can verify costs. Request a loan estimate from your lender and compare it to industry averages on Closing Corp or Zillow. Watch for red flags like miscellaneous fees or costs exceeding 5%. Negotiate origination fees or shop other lenders if costs seem high. Check your costs. Are they 2 to 5% and clearly disclosed, or excessive and vague? Transparent costs aren't just affordability, they're a hallmark of a mortgage deal you can trust. If you're finding these insights valuable, please comment number 2 below to let me know you're here. And if you haven't subscribed, consider doing so and turning on notifications to stay updated with more home buying wisdom. Sign 3. The lender offers flexible repayment terms. When your lender offers flexible repayment terms, such as choosing between 15-, 20-, or 30-year terms, or allowing extra payments without penalties, it's a clear sign you're getting a good mortgage deal. A 2024 article in Forbes notes that flexibility in loan terms lets borrowers tailor payments to their financial situation, with 30-year terms lowering monthly costs, e.g., $1,896 at 6.5% for $300,000, and 15-year terms saving interest, $104,760 versus $382,560. Prepayment flexibility, without fees, enables faster payoff if your income grows. Consider Zoe and Ethan, both 38, taking $250,000 mortgages. Zoe's lender offers 15 or 30-year options and no prepayment penalties, letting her choose a 30-year term and pay $500 extra monthly when possible, cutting interest by $50,000. Ethan's lender locks him into a 30-year term with a 3% prepayment penalty, limiting his ability to save. Zoe's flexible terms signal a great deal, while Ethan's rigidity kindles frustration. Flexible terms don't just ease payments, they adapt to life changes, reduce interest, and empower financial control. The good news? You can seek flexibility. Review your lender's term options, ask for 15-, 20-, or 30-year quotes to compare payments and interest. Confirm no prepayment penalties in the loan agreement, check the fine print. If terms are inflexible, shop lenders like Navy Federal or Quicken Loans. Ask yourself, does your lender offer flexible terms or rigid ones? Flexibility isn't just convenience, it's a mortgage deal that grows with you. Sign 4. You're not being pushed into a risky loan type. If your lender isn't pressuring you into a risky loan type, like adjustable rate mortgages, ARMs, with low teaser rates, interest-only loans, or loans requiring private mortgage insurance, PMI, despite a 20% down payment, it's a vital sign you're getting a good deal. A 2023 CFPB report warns that risky loans, such as ARMs with rates jumping from 4% to 8% after 5 years, can spike payments, e.g., $1,432 to $2,149 on a $300,000 loan, risking affordability. A lender offering stable, fixed-rate loans or clear PMI terms reflects fairness and care for your financial health. Think of Ava and Lucas, both 36, applying for $350,000 loans. Ava's lender recommends a 30-year fixed-rate loan at 6.5%, ensuring predictable $2,211 payments. Lucas's lender pushes a 5-to-1 ARM at 4%, initially $1,672, but after 5 years, the rate could hit 9%, $2,899, stressing his budget. Ava's stable loan signals a solid deal, while Lucas's risky loan kindles uncertainty. Avoiding risky loans doesn't just ensure affordability, it protects against rate shocks, preserves equity, and aligns with long-term stability. The good news? You can steer clear of risk. Ask your lender to explain loan types, favor fixed rate over ARMs unless you plan to sell soon. If putting down less than 20%, confirm PMI costs, 0.5 to 1% of loan annually, and removal terms. Compare offers from credit unions or online lenders like Better.com for safer options. Check your loan. Is it stable and straightforward, or risky? A safe loan type isn't just security, it's a mortgage deal that safeguards your future. If you're finding these tips sparking ideas, please comment number 4 below to show you're with me. Subscribing and enabling notifications will keep you in the loop for more home buying insights. Sign 5. Pre-approval was straightforward and based on your finances. When your mortgage pre-approval process was straightforward, timely, and based on a thorough review of your financial situation, credit, income, debt, and assets, it's a strong sign you're getting a good deal. A 2024 study by the Mortgage Bankers Association found that reputable lenders issue pre-approvals within 1 to 3 days, using verified data to ensure you're offered a loan you can afford, with debt-to-income, DTI, ratios below 43%. A smooth, finance-based pre-approval reflects a lender's transparency and commitment to your success. Picture Sophia and Jack, both 33, seeking $400,000 mortgages. Sophia's lender pre-approves her in 2 days after reviewing her 720 credit score, $80,000 income, and 30% DTI, offering clear terms. Jack's lender takes a week, bases pre-approval on unverified estimates, and later retracts the offer, wasting time. Sophia's straightforward pre-approval signals a reliable deal, while Jack's messy process kindles distrust. A clear pre-approval doesn't just speed up home shopping, it ensures affordability, builds lender trust, and sets realistic expectations. The good news? You can ensure a solid pre-approval. Submit complete documents, pay stubs, tax returns, bank statements, to your lender upfront. Choose lenders with strong reviews on Zillow or Trustpilot, like Wells Fargo or PNC Bank. Confirm your DTI, monthly debt divided by income, is under 43%. Check your pre-approval. Was it quick and finance-based, or slow and vague? A smooth pre-approval isn't just a step, it's proof you're getting a mortgage deal that fits your life. Final thoughts. Now that you've explored these 5 signs, take a moment to celebrate your journey towards smart homeownership. Are you securing a mortgage with a competitive interest rate, reasonable closing costs, flexible repayment terms, a safe loan type, and a straightforward pre-approval, or do some signs suggest room for a better deal? The good news is that these signs, market-aligned rates, transparent costs, flexible terms, stable loans, and clear pre-approvals, are your roadmap to confirming you're getting a great mortgage. A poor mortgage can lead to high costs, unpredictable payments, or financial stress, but you're wiser than that. Start today, pick one sign to double-check, like comparing your rate to market averages or reviewing your loan estimate for hidden fees. Ask your lender about prepayment penalties or explore a fixed-rate option. These steps, however small, lock in a mortgage that supports your dreams. Your home is your future. Keep these signs in mind, and you'll secure a mortgage deal that delivers affordability, stability, and the joy of homeownership for years to come.